and gentlemen, thank you for standing by and welcome to the AMA Group 2017 full year results presentation. At this time, all participants are in listen-only mode. Viewers of the webcast can ask questions via the Ask a Questions tab at the top of the webcast. Please note that today's conference is being recorded Tuesday the 5th of September 2017 at 11 a.m. Australian Eastern Standard Time. I would now like to hand the conference over to your host today, Executive Chairman and CEO, Mr. Ray Malone. Thank you, sir. Please go ahead.
Good morning. With me today is Ashley Killick, our Group CFO, and also Terry Backos, our Company Secretary. I just want to go through roughly the overall results. We've had a fabulous year in general. Our revenues are up, EBITDA is up, earnings per share has been fantastic. The amount of bolt-ons with greenfields and acquisitions that we've done have been substantial. If I look at the pipeline on greenfields, we announced in July that we had 3 contracts that we're still yet to roll them out. That's now gone to 8, and we have another 10 on the table. So we're very, very busy there. From an acquisition point of view, we've got 14 deals we're currently working on, and it takes as long as it takes. It's with lawyers. It's all about you make your money when you buy, so we sort of don't rush in, and we just do things thoroughly, and everything's going very, very well. If I look at the overall revenues, panel was up 53%. Our gross margin is 49.9, was up. The bull bar division, the revenue was down about 6.9%, but the gross margin was slightly improved. Remanufacturing had a stellar year, as well as the panel division. The revenues was 10.3, up 33.7%, with a 26.9% increase in gross margin. And our electrical division sales come off a little. It was 14.9 million revenue for the year. Our percentage on last year was 1.1% less, and our gross margin was 2.8% more. So overall, it was a fabulous result. Our relationships with our business partners have improved dramatically. The model is now 1 more year mature. Our greenfield implementation has ramped up considerably as well, and that's been fabulous. It's a bit of a short-term pain for cash flow, but the results are staggeringly good. So our average greenfield return is 2 to 3 years, so it depends on where it's situated. And the thing with the rate of our growth and the complexity of our business and the amount of moving parts there is that it's quite frustrating for the analysts because there's so many things to measure. Overall, when you package it up and put it into one basket, it's an absolutely fabulous result, and our footprint has grown substantially, and we're getting more than the lion's share of all of the opportunity to roll out. So we've done some great business with A&G, with a exclusive. We've got the exclusive contract for down in Geelong, so what we did there worked very, very well. And if you look at Canberra, we now have 8 very, very substantial facilities in Canberra, and it's worked really well for us. We're putting the last year has seen the golden handcuffs go on a lot of very, very talented individuals, and that we're all working for the same agenda, which is in the interest of the shareholders. So that part of the model's working really well. The Gemini businesses are performing absolutely fabulous. Everyone's working really well together, and it's all going to plan. So if I looked at the overall of where I thought we would be to where we've actually landed, we've landed ahead of where I thought, and it's at the top end of all expectations, so it's been great. And because of our buying power and the work we've put into our procurement and how we view supply chain, we currently have about a 14% advantage on where we used to be. So we've sort of given 4% of that away to our business partners for the scale benefits that they bring through and to do the right thing by them. And we believe we'll have a sustainable 10% margin going forward. So our cost of acquisition, we buy things in all different manners, and every deal's a slightly different deal. So that's probably a bit frustrating for the analysts as well. But if you look at one of the deals we did, we bought 2 sites and we basically just took over their creditors. So they couldn't make it work on their own. They were losing money. And we bought those businesses. We basically took over their liabilities, which is a strain on cash flow because our trading terms are tighter than theirs. But, they put their house up as collateral, so we've, protected the balance sheet in every form. And we've now got a fabulous business that's doing some, fairly serious volume, and it is definitely in the black. So, what's flowed through on that business is the procurement benefit that we get. So that's working very, very well. And overall, all of the deals where we have the golden handcuffs on the vendors and they're then growing their zones, it's really good. We've got the model down in Tasmania, Craig Carey down at Micro. He's a fabulous operator. He's now picked up another 3 shops, and that's all rolling in and integrating in. We've had an amazing year with the OEM, with the car manufacturers. Just VW alone in Melbourne had 7 new contracts they put out. We got 5 of the 7. So we get more than the lion's share of Subaru and Toyota, and it's going really well. So, if you look worldwide, I recently had the chairman of one of the big internationals from America over with me for the day, and he looked at our exclusive model and he said it's absolutely brilliant, and he had a look at how we're doing our procurement as well, and he just couldn't believe the results that we're getting. So overall it's been really, really, really very solid. So if I was to sum it up, I would say that we're a very, very fast growing company with enormous support from the insurers, which is backed by long-term contracts. To supplement that and to bring value, we also have the OEM. We're the solution for that space as well, and that's going really, really, really well. We need to constantly invest to meet demand, which is really a great thing. We haven't tapped into the market, into the capital markets. At this stage, we have no intention of doing that. Our cash flows, we've spent quite a lot on CapEx last year, and we've spent quite a lot on acquisition costs and rollout of greenfields, and we've done it all out of cash flow, and also we've done it out of the market invest opportunity that came into the procurement. I did that about 15 months ago. So if you look at our cash conversion, our cash in is 25 days roughly. Our inventory is about 17 days, and our accounts payable is nearly 50 days. So really the creditors are funding our debtors and our stock, and we've got a fabulous strong balance sheet with a good cash position. We currently have a $40 million facility. I've been looking at a lot of acquisition opportunity. Some of it's in supply chain, which we think, if we get the right deal, it's all about the right deal. We're not in a hurry to do anything. We're not rushing into anything. We'll measure twice, cut once. But when we get the right deal, we may need to increase our facility. So we've already had talks about that, and all of that's sorted, and it's not a problem on any level. So we're in a very, very, very strong position. our turnaround on investment's fairly quick, and our greenfield rollout has sped up considerably. So, we currently have 8 contracted that we've got our skates on, getting stuck into them, and we've also got another 10. So there's 18 there. And even out of the 10, if by the time it gets to contract stage, we only have 8, well, there's 16. So we've got a very, very long, solid runway, and we're still, virtually at the start of the consolidation, and everything we've said has come to fruition. So are there any questions for me, please? No? Okay, cool. Well, having said that, I'll just say thank you for listening.
Yeah, are there any questions that anyone has that they'd like to pose to Mr. Malone?
And I want to put you over to Ashley Killick as well, so that he can answer all the cash flow questions and some things that have cropped up externally.
Oh, one's come through by the looks, right?
All right, we've had a question posed as to whether there is a presentation that's meant to be coming up onto the screen. No, there isn't a presentation. Any questions come through?
Yes, we've got one here from Tim Plum, and it's, can we talk about first half versus second half revenue and EBITDA movement? And the revenues increased 21 million HOH, GP increased 14 million, but EBITDA was flat HOH, half and half. He'd like us to talk about initial operating losses, not startup costs within greenfields. You have previously mentioned that these typically lose 500k in the first 6 months. Go down there for me, Terry, please. And all of the, and then it says, how much would you expect these to contribute in full year 18? Okay, so one thing I want to talk about with these greenfields, and then I'll pass you on to Ashley Kelly, is that it's not linear. None of it's linear. It all depends on where the site is. It depends on what the infrastructure is around that area. It depends on what other shops are there, a million other moving parts. So what we've done to try and give something that people can understand and base some rough measurement on, we've looked at the sites, and in general we lose about $500,000 initially. Then we start to make a profit, and within a year it's normally wiped its face, and within 2 to 3 years our initial investment is normally returned. So our initial investment's anything from 900 at the very bottom end, and it can be as much as 2 million, but an average would probably be about 1.2. So it's I can't give an actual on every single little moving part. I just can't do it. But on an average, the return on investment capital is absolutely fantastic. What these facilities do, they allow us to give a very, very good cost-based price to our business partners, and we cut a lot of admin out of these sites, and we have a lot of other benefits. There's no marketing, there's no anything. It's all about process. It works for the insurer on many levels, and it works on us with us on many levels. So it's been really good. But going forward, I would say on all of those, if you factor in a roughly $500,000 in the red at the start, and then we will get after a year it will be neutral, and then we're away, and we have 10 years of those businesses contracted. That's probably the only thing I can really say. I'm going to put to Ashley in a moment. I'll keep going, and then I'll put it back to Ashley, please, Tim. So what happened to the EBITDA impact from the organic 4.7% LFL revenue growth? Should this not have at least growth underlying EBITDA by 5%? Well, we regulate it. I'll tell you what happens to it. We regulate it. And the reason we do it is because I'm in a space where I'm juggling a lot of balls, and I have an insurance industry that I'm very, very mindful of, and these are our business partners, and we need to make sure that we are always the first choice and that we are the solution for them. So I've come to a landing and I've articulated it through the market for a few years now of a 10% EBITDA margin. The market gave me the feedback that that was sustainable and was good, and then from the other side the insurers are very, very happy with that. So we have a lot of shops. We are the last to always put up our hand to raise prices. If you look at these take or pays, we had an arrangement with a very large insurer to keep the costs on hold, and we're only just revisiting them all now. So where we can, we keep our costs down as low as we humanly possibly can, and it's about a sustainable margin for the future. So on the back of that, I have what I buy the business for. So with these greenfields, I'm getting all that revenue and all of that basic control for that space where we basically own those that PMA and those postcodes, and we get a whole heap of other fabulous business that comes out of that. So we have that opportunity, which is brilliant, and to do the right thing, it's all about a win-win and one hand washing the other. And this is where it's solution driven. It's like if we stop growing tomorrow, our margin would probably improve 6% immediately. But we're not going to stop growing tomorrow. We put an enormous amount of energy and time into creating a machine that can roll out these facilities fairly effortlessly. We've done that many of them now that it's just like the back of our hand, and it's working extremely well. And we know the numbers, and we've got enough historical data to have confidence in exactly what we're doing, that we have a sustainable margin. So, we get all of the revenue from those from a very small investment. We then get all of the offshoot of that into all of our out-of-scope sites and everything, in those regions. And we're currently buying, apart from setting up enough golden handcuff deals to be able to always deliver for our business partners as well, and to prosper a win-win, we're buying very, very cheap. So as we grow, for us to go where we are, from where we were to where we are, we've grown substantially in the last year. We said we would, and we have. And for us to go to the next level, we do it without a lot of cash and without a lot of cost to us. And when we buy a going concern, like that example I gave before of the business where we basically took over their liability, and we took the business with bricks and mortar security on it. When we get those, we hit the ground running, and we get a fabulous result really quick, and we get a whole heap of synergy benefit. And then as a company, we get the arbitrage as that rolls in. So, because we're still buying them on low money. So we think that overall we'll get to $1 billion of revenue. We do it out of cash flow and the market invest opportunity that we have, so that'll all come through. And we don't need to tap the markets, and we, even if the pie, we think it'll stay where it is, the revenue pie, but if the revenue pie shrinks, it isn't going to affect us on any level. Now you will see one thing that probably seems a little odd, and that is that our gross margin in panels come off 1.2%. So we had 53.1% sales growth. Our gross margin growth was 49.9%, and our gross margin percentage came off a tiny little bit. Well, the reason for that is because we're doing more out of scope work, more larger work. So in order to bring value to our insurer partners, we're now doing hub and spoke, because we have a national model, so we actually can do it, and we're doing a lot more larger work, and we're soaking up the space better. So we got 4.7% organic growth last year. Overall, our gross margin was down a little, but what we actually did, that doesn't include any of the greenfield sites. So we're not factoring any of that in. Let me have a look. Let's have a look. My apologies. Okay, Tim Plum, repayment of paint rebates, 5.5 million, and normalisation of working capital from acquisitions, 2 million. Can you please confirm that these amounts are included in the multiples that you publish, i.e. for Gemini, was this included within a 7.5 times EBITDA multiple? Can you go down on that for me, please? Now, to answer that is, as we buy businesses, we don't have a paint prebate in our business at all. We have a market invest. And a market invest is what we're drilling down annually. These businesses that we buy, the old system used to be that you give up your discount. So you say you're on a 30% discount, you'll go to a 20%, and the dealers or the paint manufacturers will prepay you some of your future discount, and you'll have a quantum, and then when you hit that revenue number, it'll slowly amortise and you're away. Ours is completely different. We haven't given up any discount. Ours is for exclusivity. We then get an extra benefit over and above what we had before. So when we bought the Gemini business, it had a prebate in the old system. It was with a competitive paint company, and nearly all the businesses we buy have these types of arrangements. So it's a bit of a drain on cash flow, but it doesn't matter because we pick it up at the other end. So if you think about it though, it shows that it wasn't the case with Gemini, but with a lot of the small operators, it shows the amount of squeeze and difficulty that has been on the industry, and it shows how good a position we're in with a strong balance sheet and our relationships and our ability to meet the needs of a changing industry. And there's really 3 waves that have changed this industry. There's Suncorp vertically integrating, there's IAG with the exclusives, and there's also us. It's us keeping the prices fair and equitable for our business partners. I'll let Ashley answer the cash conversion and a few of these other more technical things. Okay, here we go. Joshua Hain. What is your expectation for long-term EBITDA margins as mix shift changes with more greenfield sites? Well, Josh, the expectation is that we will maintain a 10% margin. I'm not interested in doing 15% and having issues. I'm interested in a sustainable, fair, equitable deal for all of our business partners, and in constantly being the solution. Because, up to now we're the solution, hand over fist, and we've got more work and opportunity than we can point a stick at. And whilst we look like a swan, we're going like a cut cat, and everyone's, seriously into it. So from that point of view, our margins will stay the same. Our buying price for these businesses is cheap as chips. We're picking up things for some of them just for not even a third of what the written down plant and equipment is. It's a mix of things. We've got a whole heap of businesses that we're buying, and some are golden handcuffs, some aren't. The greenfields are fabulous for us. They're super profitable, and from a market point of view, from a return on investment capital point of view, they're fantastic from that way. But they're also great because strategically it allows us to hub and spoke and support other businesses that we have around them, and to get a great return, and it gives us the scale and the benefits. And from all of that, it's all about where we got to go to. It's actually not where we are today. So, if I look at the future, we've set this business up so that it is by default not doing anything other than more of the same. We'll just double it, and then we'll double it again, because we really are the solution. Our exclusives have a huge saving, absolutely stellar saving to the work provider, and that's without them taking out the friction cost their end. So just in friction cost alone is at least a 10%, maybe 15% margin for these guys. So we've been trialling now this hub and spoke concept, and it works extremely well. That's where in that zone we'll get all of that work, and we just push it into where we're specialised to do it. So we have OEM specialised shops, we have large out of scope specialised shops, and we have a whole heap of rapid small shops. So and we have prestige. So we can sort of hub and spoke it everywhere. We're the only offering in the market that actually has all of that. We've got a whole heap of questions from Mr. Plum. So good morning, Tim. I'm going to let Ashley answer those. I'll just go on and Martin Pretty. Hi Ray, what is the scale of the greenfields opportunities from here? How do you look at balancing the opportunity to invest versus delivering earnings growth? Well, Martin, that's a very, very good question, and it is a juggling act. But if we need to roll out 50, we'll just do it. Whatever our business partners need, that's exactly what's going to happen. And if you look at it now, we've been managing it, but it's actually starting to ramp up a little bit because the model is so good and it delivers so well that even now all the challenger brand insurers are looking at it, have been looking at it for quite some time, and we've started doing some work there, and it's vitally important for them to remain competitive as well. So it's just common sense. It's absolute common sense, and we are, I believe we're leading the world in our approach. And in America, they don't have exclusives. They have issues with the Constitution and with guaranteed volumes and a whole heap of other things over there, so they don't have it. And the way the market has been set up here, it's allowed us to be able to deliver for our business partners, build a long-term, sustainable, quality business that's based around fairness and transparency and delivery. And our model, it's got a lot of moving bits to it. These golden handcuff deals, they're to ensure quality with rapid growth. We got our skates on. We're growing this business as quickly as we humanly possibly can in a sustainable manner, and that's been really cool. So, okay, so this is Mr. Plum. I might be able to do this one instead of handing it over. Given the current trajectory of the business and the acquisition greenfields that you have locked away, how are you thinking about 18 EBITDA? Well, normally I'm not really a huge guidance person because of all the moving bits, but the market's been a bit not jittery. It's been a little bit, I suppose, concerned with the complexity of our business. So I feel very, very comfortable with 48 million EBITDA underlying earnings, and I have no issue with that at all. So here we are, Aidan Brooksby. Presumably some of the acquisitions during the year started from a loss-making position and get a profit once you put your procurement benefits through. Were acquisitions ex-Gemini in total additive to both revenue and earnings during the year, or just revenue so far? Okay, Aidan, the thing with it is, we've got so much going on with so many moving bits, and some of them making a loss, and then we'll roll it in and they come good. But how long it takes for them to come good, and you have other events. We had storm events in Queensland. None of these results show any recovery type allowance for any of that. So we're currently going through that at the moment with our insurers, and there's so many moving parts that all I can say is I'm in the trade, I'm in the thick of it, and I can't give a definitive answer.
But fair to say, Ray, I think a lot of the analysts have misunderstood and put in place the fact that these acquisitions earn 10% immediately.
Yeah.
And there is a time delay for that to wind up.
Yeah.
So there is this lag that causes a drag on our operating result.
Yeah.
And you can see the back end, a lot of acquisitions happened in the back end, and a lot of greenfields happened in the second half as well. And so therefore there was a drag on our operating results and our EBITDA margins as a result of that.
Yeah, but that's understandable, and overall we beat the street anyway, So you can't analyse it to that level and have it like every little moving bit exactly what it is. I've noticed as I've been dealing with the guys over the last several years that it's very, very frustrating for them, but I can't be that definitive on everything. other than to apply common sense and to now apply the historical of the model. So if you look year on year, the model has been stellar. It's been absolutely fantastic. It's brilliant. We're getting amazing results. And, you know, I might be building a group of savvy individuals together at 4 times EBITDA on their multiple, but everything else that we buy after that is just, it's fabulous. And, you know, some businesses, we bought one business, we grew so fast down in, a good example of that is we grew so fast in Canberra, and we ended up buying business to take 30 staff out of it because we needed the staff, you know. So we're juggling a lot of balls, but in all, you've just got to apply common sense. And the common sense is that we are the solution. The revenue runway is vast. We're at the start of it. You know, if you go back to 3 years ago, June, our panel revenue was 14.6 million and we had 3 shops. You know, today, which it's around about 165 or 170 weeks later, we have a balance sheet that's just absolutely fabulous, and we have 93 sheds. We've picked the eyes out of all the good operators nationally, and our balance sheet is fantastic. And our relationships with both insurer and OE and fleet are absolutely fabulous as well. So we put ourselves into an extremely strong, positive position to keep doing more of what we're doing. So, you know, we're also opportunists and we're working for our shareholders. So as we go, we see all different types of opportunity. We're flexible. You know, the demographic of who we're buying, not demographic, the age, my apology, of who we're buying, you know, the average age is 67 of these vendors. And, you know, 98% of them own no succession, and 95% of them own the dirt. So, you know, we are the solution to them. And obviously you get different pockets around the country where you have hail and you have all of these things. And it's a blessing to us that the whole thing doesn't roll up tomorrow, because we couldn't cope with it. We bit off half an elephant and we've been chewing like buggery, but nowadays it's working really well. We're delivering as and when needed. So if IAG say to us tomorrow, we want 20 expresses, well, then we've got to look at how we fund that and what we're doing. But the way it's going and the way it's been rolling out, even them, because this is a new transformational way to do business for all of us. It's not just for me, and it's for the insurers and our business partners as well. And it's a test and learn, and the more we go, the stronger it gets and the better it gets. So here we are. Sorry, my apology. Was trying to get to the point of EBITDA being flat half on half, notwithstanding it was in line with guidance, despite the revenue growth. Aidan, that is true. It is flat half on half, and if you look at our growth and what we've done, we've absolutely gone absolutely ballistic. And as long as I hit the number for the full year, I'm a fairly happy man, let me tell you. So, you know, I had in the second half, I had that bloody rotten cyclone, and it terrorised Queensland. You know, we have about 25 sites in Queensland, and we also have ECB, and we have KT cables up there. So, you know, we got absolutely bollocked. So if I was to factor that into the number, then it's, you know, it's not really flat half on half. It's then a better second half. So there's all these things that affect it, and all we're doing is we've just got a great model, roll it out like a machine. Everything's now proven, working, cool, plenty of cash, great balance sheet, great everything, and we just we have a national offering, so we're affected by, you know, local economies from around the country, and you have all different moving bits in that, and obviously the storms and things like that have an impact. You know, they have an impact, and I apologise if I'm you know, appear vague or, you know, can't give a definitive to everybody. But all I can say is, you know, have a look at the historical. look at what we said we would do, look at where we currently are, look at the common sense of where the future is. There's really nobody else, to contend with at the moment doing this. And even if there was 3 or 4 of us, there's still that much revenue that it wouldn't make any difference either,
So there are a couple of questions on that. There you
go. Okay, James Ferrier. Hi Ray, I think you mentioned shop count at 93 now compared to 86, I think at 30 June. Could you please provide some details on the increase, i.e. acquisitions, greenfields and openings? I might pass that on to Ashley because I've been talking a lot. Go for it, mate.
So 86 at June 30. We announced 4 acquisitions in July and 3 greenfields. So that's how we took it up to 93 now. As Ray said before, there's another 5 greenfields that contracts are being finalised on, and another 10 that we're still working, drafting up contracts at the moment. So,
But what I've got to say, James, it's all about being realistic as well. You can't just say, well, there you've got that, and that's going to be this, and that's going to be linear, and you're going to punch its lights out, and you're going to do all this stuff, because it doesn't work like that. Because you'll have 10 things will be fabulous positives, and then you'll have 3 or 4 dragging it down in other areas, and it's called growing pains, and that's really how it is. So our growth has been absolutely unbelievable. It's been unbelievable, and it'll continue to be unbelievable, because that's the soft bed that we put ourselves in. But it won't all be linear, just up, because it doesn't help, and it's not realistic. But overall, we will get a fantastic return for our shareholders. We are building an amazing annuity company, business, basically, stream, and it's brilliant.
So there was a question on marketing first, I think, earlier on.
Well, there's one here from Mr. Jeffries. Second half EBITDA margin decline. Was there anything that would impact that outside greenfield, such as some OPEX investment or the like?
Yeah, so that's what I've discussed before. That's the brownfield acquisitions being a drag, as well as the greenfield acquisitions.
Yeah, from a timing point of view.
Yeah.
It's all timing.
Yeah.
And quite often you go into this business and, providing we protect our balance sheet and our investments, what happens is you go into these things and you've got a fair amount of work to do, and some are more work and some are less work, and you've got cultures in these places that you have to change, and some are easier to change the culture and some are harder to change the culture. There's a lot of things like from a process point of view and a synergy benefit point of view with procurements and all of that sort of stuff, that comes through very, very fast. We get that really quickly. But, we might, we've had it where we've removed a few managers. They didn't fit the model. They weren't what we needed. We've had some golden handcuff guys that we've removed because they're not what we need for the long term for our relationship with our relationships. So, we just do the hard decisions and do what's right. And so it's just not linear. And once again, I apologise. So, how do I go back on this one, please, Terry? Is that...
That's the last question.
Oh, okay.
So yes, the greenfield's lost in the order of about 1, a bit over 1.
1.2.
Yeah.
Yeah.
Was there one on marketing first? Well, that's disappeared. You must have answered it, right?
Yeah.
So it's disappeared.
Yeah. I think that's it. Unless there's any other specific questions.
Well, thank you very much for your time to hear us out this morning, and I'll be road showing with Ashley in about 2.5 weeks. So we'll be doing Melbourne and Sydney, and by then we'll put out a presentation with a whole heap of data, and we're trying to accommodate what you need so that you can more easily work through it all and have more transparency. So thank you once again. I'll wrap it up. Oh, it's a question for Ashley. Let's do that one. Yeah, okay. My sincere apologies. Callum Sinclair asks, Ashley, can you clarify the cash flows on acquired businesses? How does management view the EBITDA multiples paid once you consider the repayments of paint, rebate and working capital investment? Are these payments partially or largely offset by the synergy or operational benefits generated after taking over?
So typically, so things like the paint rebates and the working capital investments are taken into account in determination of the purchase price. So the example Ray gave before, where we took over a business that was trading unprofitably, the vendors had a significant deficiency or significant liability that we assumed. We took that into account in determining the purchase price. So it's on an earn-out. We'll pay 4 times the earnings stream. When we released that to the market, we told the market we would pay 4 times that estimated future earnings stream, taking into account the synergies and benefits, but deducting off that working capital deficiency that we'd assumed at the start. So we'd end up paying the net amount.
And we took those businesses to plug some holes geographically because they were very important for the hub and spoke model and strategy that we've been rolling out as well.
And they were located in the centre of a population growth area. So we saw the opportunities for that business to grow and expand.
So we picked them up for less than the capex in them, or the plant and equipment. We pick up all the staff, and we got some culture things to fix and everything, but we have bricks and mortar to secure it all. So, for us, it's a no-brainer, and it ends up being a win-win. And at the end of the day, we actually want to have a great relationship with vendors, and we want to do what's right for all parties, to be honest.
Very good.